Hi, David Reyes here, Reyes Financial Architecture. Hope you're doing well. Felt it's appropriate. I'll probably be doing a lot more updates here because the market has become so volatile. Today the Dow was down about 900 points, almost 4% intraday. Ended the day down about 500 points, a little less than 2%. But I'm starting to get concerned. I have been for a while. If you listen to me for a long time, I've talked about these three phases of a market, and we're basically in the phase three. So phase one, as I talk about, number one was the loss, down 35% in basically 6 weeks from February down into March. Then we had this massive rally up 60% up into September 2nd. Basically back to even. Had a little, I think we're up about 3% right now. Now, this is phase two. This is how bear markets work. We're now in phase three, which is the big question mark, which is now not such a question mark. So what's happening now is just since September 2nd, you've had the NASDAQ is down 12%, the NASDAQ, and you've had the S&P down 8%. Okay, you're talking 3 weeks. So the problem with this market is a couple things. Number one, because we've had so much volatility on the up and down side, we're starting to see that impact again as far as this velocity of these moves. The NASDAQ dropped in 3 days, down 10%, the fastest ever dropped in the history of the market. We've had all these records. We had the fastest drop of 35% in the first part of the year, the biggest recovery. So now that we're in this phase three of the marketplace that I've talked about, we don't know where we're at here. We don't know where this bottom is. And there's a few things that are happening that are all, difficult. I've just seen so much speculation. I've seen so much apathy, not the concern I normally see clients have about protecting their capital. And I'm finally now getting some calls from my radio show listeners, people that watch us on television, that are now getting concerned. I want you to be protected before we have a massive crash here in the market, if that's what's going to happen. So what's going on here? First off, the Federal Reserve came out with their FOMC meeting that they do once a quarter. Not very well received. They said they're going to hold interest rates steady at, basically at zero for the next 3 years. And they just don't have a lot of things they can do now. They're really focusing on, they need help from the Congress. And, with all the things that are happening now with the Supreme Court justice problem, which is the last thing we probably needed politically and also for the marketplace, it really puts in the back burner the stimulus that probably needs to happen again for small businesses and other people that are out of work. And that's not good for the market. And the market's been counting on another stimulus package, so is the Federal Reserve. So that's really weighing heavily on the markets and really doesn't bode well for the fourth quarter, because if that doesn't happen, the market's going to continue to fall off. And so I'm really concerned about that. Biden just came out with a tax plan that I'm concerned about as well. I think he wants to increase the capital gains tax rates from the highs of 23% all the way to 38%. Big problem. Back in 87, in 2012, you saw tax increases in capital gains rates. You saw the acceleration of sale of assets, both real hard assets and stocks, by 40 to 50 to 60%. That's a negative on the market. We're in a negative seasonality. September and October are traditionally the worst months of the year. You have an election, obviously, that's probably going to be contested at some level from everything I read and hear. There's so many things that are concerning me. I cannot tell you or pound the table enough to say, hey, you got to be careful. There's, again, a lot of people have kind of thrown caution to the wind the last few months because we've had this, I call it the gift of the market, coming all the way back. And I don't want to see you get back to where we were in February and March. So one of the things that really concerns me, talking about the Federal Reserve, is that they've said they're going to keep interest rates to basically zero for the next 3 years. Well, that's all fine and dandy, but the fact is the unintended consequence of low interest rates, that hurts savers because you're not making any money. The 10-year yield on a treasury bond right now is about 0.5%. 0.5%. A 30-year treasury pays about 1.25%. I mean, if you hold a bond for 10 to 30 years, a 10-year bond, you're getting paid 0.6%. So the reason I bring that up as well is bonds are a really poor mechanism right now, specifically for risk management. Okay, and part of our job we have a saying is that we want the most amount of income with the least amount of risk and never run out of money. And we say that with the fact we have to protect capital. Every dollar we lose is less income we can produce. So what we're taught is that bonds will help to reduce risk in our portfolios. Well, the problem is right now bonds are not helping. The Federal Reserve is keeping rates low, which is great in one aspect for mortgages, things like that. It's horrible for savers and for income. And it's really bad for the risk management of your portfolio because we're taught to buy bonds to help to mitigate losses. I did a little bit of research here. So from September basically to the 1st to September today, which is what, the 21st? You've had the NASDAQ is down 12%, the S&P is down 8%, and you have 10-year bonds are down about 0.3%. Okay, you actually have high yield bonds are down 2%. So think about this for a minute. You own stocks, they're down. You own bonds, they're down. Gold's actually down. All the things you would think that would help mitigate the loss in your portfolio are not working. And this happens sometimes. So not only do I not like bonds because we're not making money from them, I consider them a dead asset, but they're also hurting the portfolio from a loss perspective. So I want to help you and teach you some things that we do. We will actually have portfolios where we hedge the portfolio, meaning we're going to protect the downside actively. So imagine in your portfolio, if you actually had, there's two things that we do. Number one, we're going to have multiple asset classes. We're going to have stocks. We're going to have annuities potentially. We're going to have real estate. All these things don't correlate to each other, so we're going to have less risk because we're going to really be diversified. Most of you are not diversified. You own just stocks and bonds. I'm telling you, don't like bonds. They're not paying us anything, and right now they're actually falling with the stock market. So first off, we want to diversify in multiple asset classes. Again, stocks, real estate, annuities, other things like that. But what if I could, in the stock or equity portfolio, what if I actually had a mechanism where I could actually manage the downside actively and help to protect your portfolio? So one of the things that we do in our hedged equity strategy is there's a piece of the portfolio, as the stock market's going down, we have a piece of the portfolio that actually mathematically goes up. Okay? And a lot of professional traders and institutions use this. So for an example, let's just say, and this is for illustration purposes only, let's say the market is down 10%, but you have a piece of the portfolio that goes up in direct relationship to the stock market. So let's say it's up 10%, and let's say that's a piece of your portfolio. So what's going to happen is it's going to stop the bleeding here. So as the market continues to fall and a piece of your portfolio is going up, we actually can reduce the risk or volatility of the market by having something within the portfolio that actually will go up in value mathematically as the market falls. So real risk management. So I'm sharing some things, a longer video. I'm going to talk more about our risk managed hedged equity portfolio in a separate video, but I'm bringing it up today because we have tools, we have things that we do for clients, whether we're diversifying with different asset classes, again, real estate, annuities, other things, or we're actually hedging, protecting the downside of our equity portfolios. So if you want to reach out to me, get a second opinion, have me evaluate what you have, look at the fees you're paying, most importantly, protect what you have.